Bridge loans, what are they and how do they work? I'm Brooks Kelly, and I've been a lender for over 17 years, and I've helped over 2,000 families purchase or refinance their dream home. And today we're going to talk about bridge loans because it's a big topic in our market when someone wants to buy a house before they sell their own. Now, you might think that that's kind of a crazy concept to own two houses at the same time, but in a lot of cases, you've built up a lot of equity in your house and you don't want to sell it and then hope that the next one's on the market tomorrow. So trying to make those two transactions go congruently can cause a problem, and that's why bridge loans exist. Now, I'm going to talk about them in detail, and especially in the state of Texas where bridge loans are very difficult to do. The traditional term bridge loan means bridging two properties together with one loan. So think about it in this way. Say you own a home, say it's worth $1 million, and you have a $500,000 mortgage on it. And now you want to buy $1.5 million home. You're making that move up. You had some kids and you need a bigger house. Well, you need that $500,000 to buy the next house because all your other money's invested or you don't have any other money, whatever it is. And you need that $500,000 to buy the next house. Well, traditionally in almost any other state, you can do a loan where it takes both houses and it pays off the original $500,000 loan. And then it cross-collateralizes, it puts the two loans together with one mortgage. So you're able to utilize the equity in the first house in order to cover both homes' mortgage until you sell the first home. So you're able to move into your new house, you're able to finance it, you don't have to worry about pulling equity or getting a gift from someone else, and now you have both homes. Now you sell your other house, and you sell it for $1 million. Now you have that $1 million in assets in order to put down on the new loan. So at this point, you're going to have that $1 million in the bank. Your home is sold and paid off, and you have to do a new loan on your new house, a permanent 30-year mortgage or whatever term you want. So you use that money in order to do a refinance on that new house and only on that one property. So that's the traditional term of a bridge loan, bridging two properties together. The term is used very loosely in real estate today. What you're really trying to do is bridge the gap between owning one home and owning the next. And there's tons and tons of different ways to do this. Now in Texas, the reason why you cannot bridge two properties together is due to the Texas home equity laws. And if you watched my last video about the Texas cash out, you cannot do anything with your primary residence that might jeopardize your homestead. So you're not allowed to bridge the two properties together if one of those is your homestead or your primary residence. So you have to come up with different options. And the best way to go about it, in my opinion, is to do a home equity loan or a home equity line of credit on your current primary residence. And then you take that money and put that down on the next house. The limiting factor is you can only go up to 80% of the value of that home. So you're not able to get all the cash out of the house. But if you can qualify with both payments, then you can make this situation work. So you have to be a big earner in order to afford two properties, especially in the range that I was talking about earlier. So there are other ways to go about this and span that gap. There's a lot of different programs out there. Many of them that we offer here is in order to get rid of that first mortgage. So you can take a non-contingent contract from a specific company that will also let you take a HELOC or a HELoan against your current house and use that money for the purchase of the other. Now, the specifics of the non-contingent contract work with this program if you're doing a conventional loan backed by Fannie Mae or Freddie Mac. And when they say you have a non-contingent contract on the sale of your home, then you don't have to count the debt against the purchase of the new house. So it's a loophole that's in their guidelines that allows you to bridge this gap by doing a different sort of option that gets you to point B. So a third option to bridge the gap is a buy before you sell program. Now you can take a buy before you sell, and it means exactly what I say it is you can take that program and purchase a home with an entity that's giving you that money, and you qualify obviously for that new purchase once you sell your house, but you're not the owner on that house in the beginning. You pay a specific fee to that company, they buy the home, you have a contract to buy the home for the same price within 6 months, and then you put your house on the market. And then when you sell your house, just like you would before, And just like you found that house out in the wild and it just happened to be available, except for you now have a contract on it, you're now able to purchase that just like you would before. So you just use a normal mortgage, you purchase the house from that investor, and you go on your merry way. So bridge lending has got tons and tons of different options with it. Those are just 3 of the ways that it can happen. It's specific to every client, and it's something that you should evaluate specifically for you. So if you have questions about it or would love to go over your scenario with you, just reach out at brookskelly.com or click the link below. Thanks.